we often say, wow, it's unbelievable what the prices are for things, right? And we get, every time we see a new property sell and we say, wow, it went for that much, we think this is crazy, right? But we all agree, everybody I talk to who's doing this all day like I am, we all agree that the odds are much, much higher that 2 years from now, we'll be sitting here in August, September 2023, and we'll be saying, do you remember back in 2021 when you could buy real estate for that price? Because the odds are much greater that property values are going to be significantly higher 2 years from today than they are today. There's not many people, despite the kind of feeling in disbelief about where property values are going, there's very few quote unquote experts who really believe that a year or two property values are going to be lower.
Starting your route to retirement.
Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group, your host of the Guided Retirement Show. Back again, Don Wenner of DLP Capital. He had some really exciting things going on in episode 46. The guy is on a tear, building an organization, hiring hundreds of people, and really doing some amazing things. We're going to get into some conversations with Don today about how business is going and what he's done since our last conversation. We're going to spend a lot of time talking about real estate and investing in real estate. Please enjoy my conversation with Don Wenner. All right, Don Wenner, DLP Capital. Welcome back to the Guided Retirement Show. Such a pleasure to have you back. And if you missed the first episode with Don, it's episode 46 of the Guided Retirement Show. Don, how you doing today?
I'm doing awesome, Dean. Thank you so much for having me back once again.
And it sounds like you've made a ton of progress in your business since our last conversation. So congratulations on the continued success. Why don't you tell us a little bit about what's gone on since our last talk?
Yeah, thanks, Dean. Yeah, it's been for many of us, we're blessed. This has been a great year, and so we've been quite busy. Continuing, we like to say our 20-mile march, and kind of marching forward each day. In the last, I think it's been about 3 months since we were together, and we've added about 100 team members, 100 employees. We went under contract to acquire a bank, which we close on later this year. And we're finalizing some other, we like to say, big moves to keep driving the organization forward and serving our clients. So it's been a heck of a first almost 8 months of the year here.
Yeah, cool. Good job, man. Good job. It's exciting to see young people out there really just killing it and making a difference in the world. Don, I want to talk to you today, and I want to get your views as a business owner and a real estate, I'm going to call you a real estate expert, and just a serial entrepreneur. Some things that we're hearing that are on the minds of a lot of people out there. And I think you and I can just have a great dialogue about this. So 3 things happening right now that I call kind of the triple threat, okay? You've got the threat of inflation, which we have not really seen inflation for a long, long time. I was talking with one of my business partners here, and nobody that is in our industry right now has actually experienced what inflation can do, because most of the people that are in the industry now, even if they've been in it for 40 years, they were in 1981, and that was when the inflation was ending. And so we've been in a lower inflationary environment now for 4 decades. And the second part of that is higher inflation comes with the threat of higher interest rates. Higher interest rates means a higher cost of capital for businesses. It also means that people can look to fixed income sources instead of stocks, which has been really the only game in town besides real estate where you can make any money. And so that triple threat could mean, hey, we got higher inflation, interest rates are going to go up, stocks are going to fall, and if interest rates are going up from the 10-year Treasury, as we record this at 1.3%, you're not going to get safety in bonds. And so I want to have some conversations with you as a business owner, guy that's just buying a bank, you do lending. How do you see all this playing out, Don? What do you think the risks are? And then we'll talk about how to mitigate some of those risks.
Yeah, that's a big topic there for sure. So I'll hit maybe a couple things start with, and we can interact through it. So how I think about the world of investments or making an investment, in my mind, there's 2 things that are always most important, or 2 things that you evaluate. One is management. So, the quality of the management, and then two is the strategy. And I always think about it, in any market, in any economy, in any cycle, there's always, managers who outperform, other people in their sector, in the asset class, et cetera. Right. So it's really, really critical that you have, you're investing with the best managers. And then two is strategy. And it's really critical that the strategy makes sense over the life of how long you plan to have this investment, and with what's going on in the economy, such as higher interest rates and inflation and so forth. So that's how I think about investments. And then I also always think about—
All right, hold on. Hang on, Don, because you make an excellent point. But on the flip side of that, you've got John Bogle of the Vanguard funds telling you that there's an easy button, right? There's an easy button and it's cheap. And all you got to do is put some money in my Vanguard real estate fund, put some money in my Vanguard total stock market fund, put some money in my Vanguard bond fund. And that's going to take care of all of it. So that removes any of the strategy or the management that you just talked about. How has our industry gotten to a point, in your opinion, where people just want to say, oh, it's that simple? And if that's the strategy that somebody decides to employ over the next decade, I think they're going to be in for a rude awakening, because I don't think you're going to see the same types of performance out of those types of investments over the next decade that we've seen over the last 20 years.
Yeah, it's a great point. Again, my world is mainly, as you said earlier, is mainly around, real estate, more specifically housing. And we invest in that asset class as a lender and as an owner. And the way one of the things I remember, the great Sam Zell, who's one of the best real estate investors of all time, always says, we buy deals, not markets. And so great managers are able to find deals and opportunities that when against the trend of what everybody else is doing. And a piece of real estate can be a great piece of real estate at one price, can be a great investment, and another price can be a terrible investment or not so good of an investment. As an example, when COVID hit, we found a lot of student housing operators struggled, especially in the beginning when the schools were shut down, and a lot of them defaulted on loans because they didn't have occupancy in a lot of areas. So we went after an approach. We said, hey, there's an opportunity here, because a lot of these student housing communities are built just the same as multifamily, but the ownership only knows how to run it as a student asset, and the loan was set up to be a student asset. So we've bought now 3 communities, about 1,000 apartments in the last year, which were always student housing communities. We bought them at big discounts when the market's been so hot for multifamily. Nobody was thinking about, not nobody, but very few were thinking about student housing opportunities. And we've converted those to just being market units available to all families as well as students. We're not against students, but we're opening up the market to all residents looking for good, affordable housing, right? And that simple thought, very few took that approach. And we've been able to pick up some really phenomenal opportunities. And that's the thing, when there's volatility in the market and everything you're talking about, higher interest rates, inflation, value changes, that's volatility, right? And when there's volatility, active management becomes really important. The ability to be able to pay attention to the trends and what's going on and see opportunity. And that's, that for people like us, we invest in some level of distress and opportunity. So when volatility comes about and higher interest rates, changes in tax codes, inflation, all these things create fear. They create people who make change. That creates, opportunities. And that's where the second part becomes really valuable is the strategy. Do you have a strategy that makes sense in an environment where interest rates go up? Do you have a strategy that makes sense in an environment where inflation happens? Do you have a strategy that makes sense if we go into, recessionary, environment and values are down? And that's why why we're in the 2 main strategies we're in. You think about our business, we do short-term bridge lending. So we make 6 to 12 month loans to real estate investors. Well, guess what happens if interest rates go up? My returns go up. I'm a lender, right? And I'm not making long-term loans. I'm only locking in my interest rates usually for 6 to 9 months. So if rates went up a ton, that would be a great thing for me and a great thing for my investors. In addition, if interest rates go up on the portfolio where we own the real estate, we lock in our interest rates for 10 to 30 years. So we're going to lock in our interest rates where our debt isn't going to go up. Yet generally, if we're in an inflationary environment where interest rates go up, that means rents are going to keep going up. So my income is going to go up, but my debt is going to stay flat, right? That's a really good environment to be in. If we're in a recessionary environment and people are, if high unemployment and, companies aren't starting and so forth, what does that mean? That means that people need affordable places to live. Well, our average rents in our portfolio is a little less than $900 a month. When we're in tough environments, there's more demand for $900 apartments than less. I mean, there's more demand in most parts of the country for $900 apartments when the market's great as well, because we have such an immense undersupply of housing. And that's what I always come back to. My last big point here is, Warren Buffett, who many think to be the greatest capitalist in history, right? But I always think of Warren Buffett as he's not really a capitalist as we think about capitalism. So we think about, capitalism as somebody who goes out in the free markets and against competition and goes and, builds a great company in this open free market. Warren Buffett's strategy has always been to invest in businesses with very little competition, right? He always says if you're investing in a business where you have competition, you're in the wrong business, right? He wants to invest in a business that has a moat around it, right? Has all this, has very limited competition. And so that's, what we think of as why we're buying a bank right now. Banking's an industry where regulation is forcing there to be less and less and less banks. It's a great place to be, a place where you're not going to have new competition coming in. You're going to have less competition, a year from now or 2 years from now or 3 years from now. So those are a few of our thoughts that we definitely think, that we are in an inflationary environment. We can all see on household goods. I know they changed the calculation. Now, certain things that should be part of the inflation calculation are not, in my opinion. But inflation is happening. Look at the cost of living. Rents have gone up on average 12% in America so far this year, right? How is that not an inflationary environment? But that benefits us. Interest rates going up benefits us. I don't think interest rates go up in the next 12 to 24 months in any material way. But if they do, it would benefit our business model that we run, over the foreseeable future. And,
I think in order to get interest rates to go up in the short term, Don, that's probably not a likely scenario, because the first thing that's got to happen is the Fed's got to stop its bond buying program that's known as tapering, right? So they're going to slow that bond buying until eventually they can stop it. And it won't be until after that is completed that you'll actually see any movement on the Fed funds rate. I was just looking at some economist information just before I jumped on here with you today, and these guys are saying you might see the Fed funds rate at 2.5% by the beginning of 2024. Okay, so that's still quite a ways out, and really no movement for the balance of this year, and probably no movement even maybe the fourth quarter of next year. But it's going to be slow, but the markets will react. Real estate will react. We've seen just an amazing run in the prices of real estate. Now, I can tell you on the single family homes what we've seen. Talk to us about what's happened in the multifamily area. And before you do that, go back and tell me what kind of a deal you got on that student housing.
Yeah, absolutely. Happy to. So, yes, we bought student housing in Kutztown, Pennsylvania, which is actually where my wife graduated from. So the community sold last for $170,000 per apartment. We paid $102,000. We bought another community in Oxford, Mississippi, 2009. Actually, both these communities, oddly enough, were built in 2009. About 200 units. Last sold for about $150 a door. We paid $71,000 a door. In a market where, as you just said, property values are soaring. So finding distressed opportunities that you're paying a discount from the last time it sold is extremely rare in housing today. And to your point, yeah, I mean, it's unbelievable what's happened with property values in a piece of real estate goes on the open market with a decent real estate agent. It is unreal, both on the single family side and the multifamily side, how much values have gone up. We bought a community in August of 2020, just 1 year ago, for $60,000. We have offers on it right now for over $60 million. We have offers on it right now for over $80 million. 25% higher price, 1 year, later, right? And when you think about the leverage returns, it would work out if we close, it'll work out to be a 400 to 500% return in a year. I mean, unbelievable, right? So certainly there's been compression to cap rates, meaning people are willing to accept lower yields on properties. So that's certainly true, and partially the reason people have been able to do that is because interest rates are so incredibly low.
Right. You're borrowing money at a lot lower cost, right? So you're willing to pay a little bit more.
We're buying a portfolio right now of 4,000 apartments, about a $520 million acquisition that we close on next month. And we're locking in our interest rate for 10 years at 2.71% interest rate for 10 years locked in. So that kind of, those kind of rates really, of course, help. And that's a big part of why values have gone up. But the bigger, even more important reason why values have gone up is because rents have soared. And, I have 4 areas of impact I'm focused on personally and in my organization as our platform. And the most obvious one is workforce housing. And so we're working incredibly hard finding ways to create workforce housing that is affordable for the local workforce. And that's becoming harder and harder and harder to do. A year ago, rents had gone up 70% in the past decade. So from 2010 to 2020, rents went up 70% in America, while incomes went up 6 to 8%, depending on how you look at it.
Wow.
Rents in the last year have gone up greater in the last year than any point in recorded history. So they've only soared through COVID. And we're seeing in many markets, in Jacksonville, which I live in St. Augustine, just south of Jacksonville, the average 1-bedroom apartment is up 35% year over year, right? I mean, just unbelievable growth in rent. So it's not a good thing for the average family, the average person trying to find good, reasonable, safe, affordable housing. But as investors, the incomes and the expected continued growth in incomes, supports the values. That's the crazy thing. It's not just that people are buying housing that doesn't make any sense. There's incomes that support it. People are generating strong cash flow based on today's rents, and odds are great. We don't model it this way, but the odds are great that rents will keep growing at 6, 7, 8, 9, 10% a year, which makes it almost, frankly, impossible to do wrong if that continues to happen. We don't assume that, but if rents keep going up at that point, everything makes sense to buy in the world of housing.
So what kind of rentership do you have? I mean, what's your occupancy rate on these places? Is it a forced, hey man, there's so many people that want into this place, we're going to keep jacking up the prices because even if you don't want it, somebody else will. Is that what's happening?
Pretty much, yeah. I mean that's not the way we like to position, and we're really big on keeping our housing affordable. So we're not always stretching to get the top dollar. We're much more about keeping our residents in our properties. But with that said, right now today in our portfolio, we have vast majority of our assets range between 94 to 98% physical occupancy at any given day. And then since COVID, we've averaged across our portfolio right now, we're about 4.5% delinquency. So the challenge with COVID is for the first time in American history, as far as I know, the government said, you can't evict a tenant if they don't pay their rent, right? I mean, unheard of government, reach.
How long do you think that's going to go on?
We keep thinking it's going to end this month. So they keep extending it. I do think it will end certainly by the end of this year. But the positive side, I'll give the government credit. The positive side is through the CARES Act, there's been the incredible unemployment benefits. There's been a lot of state funding for rental assistance. So there's been a lot of positives that I'd say sort of have evened out in terms of for us as landlords if you managed well. But the reality is what is in a normal environment, if somebody can't pay their rent because we're in a recessionary environment or whatever the case is going on, we can get them out in 30 to 40 days. And as fast as we can have any apartment ready to rent, it's rented. There's no problem at any of our communities. We own communities in 22 states. We don't have a single community where if we have an apartment ready to rent, there's not somebody ready to move in.
That's crazy. Are you looking at communities all across the country, Don, or are you focused on certain areas where it's better?
Like probably most businesses today, we're very, very bullish on the Sun Belt. Warmer climates, in short, is where people are moving. Pro-business states. So our favorite areas is the Southeast, North Carolina, South Carolina, Georgia, Florida. We have offices in Western Carolinas and here in Northeast Florida. Those are sort of everything in between there is our kind of favorite area, but unfortunately everyone else has realized that too. And so lots of people are investing there. So we own a lot in, Mississippi, Alabama, Arkansas, Louisiana. We own in Kansas, Kentucky, Oklahoma, Texas. So mainly throughout the southern half of the country. Southeast is our kind of main area of focus. But really, at the end of the day, you're going to do well if you're in markets that have good population growth, strong job markets. You're gonna do well, and that's what most of the South has. Even the smaller markets, good, solid population and job growth.
So when you first started in your real estate acquisitions, we talked about this back on episode 46. And if any of you didn't listen to that, you should go back and re-listen to it, because you started out as a real estate agent and decided, hey, there's a better way to do this. And you started out buying single family homes. So do you still have a focus on single family homes, or is it primarily on the multifamily?
So a lot of people, and for good reason, historically people think about investing as single family or multifamily as two different things. And historically, the way I think about it is you invested in scattered assets, individual homes all over the place, or in a community of rental units, right? That's kind of the way people ultimately what they think of. And multifamily is a community of a bunch of renters, and a single family home is one individual renter. Over the last, especially over the last couple of years, but over the last, call it decade, that those lines are becoming a lot more blurred, and more now today, the hottest asset class in probably real estate today is what people refer to as build to rent, which is building houses for rent. And so we've built townhome communities, a whole community of townhomes that are all for rent. We've built communities of single family detached homes, all for rent. So I think that there's not an asset class that's going to have a greater demand than a single family detached home for rent. The tough thing with buying an individual home on one street and that's surrounded by homeowners, and then you own a home down across the street or the other side of town, is management.
Right.
This is a management-intensive industry, and managing turnover and maintenance requests. And I think if you got one house and I got a neighbor to the left and behind me to the right to back, I got 4 sets of neighbors. I've got a set of tax bills, probably 3 tax bills for that one property. I've got everything separate. When I have a community together, I can control the experience for the residents, the safety, the curb appeal, everything much more than I can control an individual home. So what we focus on, we like to call it as communities. We invest in communities. So whether that's single family or multifamily, a mix of both, detached, attached, single story, 4-story, high rise, we want to invest in communities where we can control delivering a great experience. We invest heavily in our communities. We want to help them, improve as people. We want to help them across the 8 F's of life that we call at DLP. We want to help them from faith, family, friends, freedom, fun, fulfillment, fitness, finance. We want to help them, improve as in life and achieving their goals. And that's hard to do when they're scattered. When we have a community and we have a clubhouse and a pool, and we can do community programs and get-togethers and create connection and relationships. They say today in America we have the highest rate of unhappiness in history right now. We have the highest rates of depression in history right now in America. And I believe that the number one reason for that is a lack of real connection.
Yeah.
And first and foremost, lack of connection with the Lord, but also real connection with other people. And we try to really invest in that in our communities. And it's hard to do when they're scattered.
I mean, that's fascinating, Don. So I didn't even realize until a couple of years ago that these build to rent communities were out there. And my father and mother-in-law were thinking about moving, and so we went and visited one of these areas. I mean, beautiful area, and I thought these places were for sale, and they're like, no, these are all for rent, everything, and they're just building one after another. Happens to be on a great golf course here in Kansas City, where you would think these are homeowners, but no, they're renters. And so I'm like, wow, who would do that? Who would rent that when they could actually buy it? So help me understand, and maybe anybody watching on YouTube or listening, help us understand what that, how do you get that appeal? Or is that just out there and people would rather do that than buy?
Yeah, it's a phenomenal question. And the reality is I'm going to kind of put COVID aside for a second, then I'm going to bring COVID into the picture. But without COVID, we have an aging population, and people in their 60s and 70s and 80s, don't want to deal with the maintenance of owning a home and the work and so forth. So we're finding the biggest growth of renters in general by far is the baby boomer generation.
Wow.
By far, that's the biggest growth in rentership is from baby boomers.
But they don't want an apartment. They don't want the apartment. They want that community that you're talking about, the house to rent.
Exactly. And don't get me wrong, they do move into apartments as well, because a lot of markets, that's all there is. But yeah, they want to go into a rental where they don't have to manage everything anymore. So the older people want to be renters. We all have probably heard the stats that people are starting their families much later in life. And people are then in turn staying renters much longer, right? And then, we all know that people, change careers, 5-6 times, actual career paths, let alone jobs every 4 or 5 years today. So because we're more transient as a society today, we're not staying hooked to one job, one career. More and more people like the flexibility of not being tied down to owning a home. Another thing that has increased the amount of people who want to be renters is that a lot of younger generation, came of age during the last, Great Recession. And so they have all the foreclosures and whatnot. So the kind of American dream of home ownership has declined a lot for the current generations. That's not considered part of the dream. I mean, think about, we're in a society today of Uber and so forth, where it's not about owning anymore. It's about borrowing, right? Using somebody else's things. Less and less young people want to own cars anymore even, right? So there's no doubt the younger generation and the older generation are becoming renters. And then, the average, I'll call it just family, those in their 30s and 40s and 50s, some are staying renters by, because they don't have any other choice. Either they can't get financing because it's not as easy as it once was, or they have some damage from past mistakes, or, the cost of housing has gone up. So all those reasons have helped continue to grow rentership. And then COVID came along, and more people, and it's not nearly as dramatic as I think the news likes to make it sound like. The whole world's not going to go work virtual. Especially younger people need to get back in the office and need to build relationships with their peers to be able to really move up in their career. But there's no doubt that we've sped up the process of the percentage of people working from home. And so think about it, if all of a sudden your home went from just being the place you came to at night to now being where you work all day, to maybe even where your kids go to school all day, right? You need more space. So that need for additional space when your home is where you are most of the time has led to this tremendous growth in people not being okay in that 800 square foot apartment, needing some more space. So they got a room to turn into an office and so forth. So all these factors have led to rentership as a whole, but certainly larger rentals like single family homes being really, really desirable.
That's fascinating. That really is. I didn't know that those communities were that prevalent throughout the country, but it makes sense what you're saying. It really does.
It's still a small percentage of the market, but it's going to grow tremendously. Most of the big hedge funds out there that own single family rentals that you hear about, like BlackRock and American Homes for Rent, they're putting most of their focus around building rental communities now.
Wow. Well, they're going to have to keep up with you, though. So let's talk about, you talked about the good stuff that's out there, the opportunities that are out there. Are there areas in the real estate market today that are less attractive and perhaps should even be avoided?
So I'll start with saying, I think as much as, here, internally with peers and my investment team, we often say, wow, it's unbelievable what the prices are for things, right? And we get, every time we see a new property sell and we say, wow, it went for that much, we think this is crazy, right? But we all agree, everybody I talk to who's doing this all day like I am, we all agree that the odds are much, much higher that 2 years from now, we'll be sitting here in August, September 2023, and we'll be saying, do you remember back in 2021 when you could buy real estate for that price? Because the odds are much greater that that property values are going to be significantly higher 2 years from today than they are today. There's not many people, despite the kind of feeling in disbelief about where property values are going, there's very few quote unquote experts who really believe that a year or two property values are going to be lower. So I want to start with saying that when it comes to housing, that doesn't mean going and just paying any price for an asset makes sense. And being the highest price to buy an asset is not usually what you want a greatest strategy. And what people often forget about is why I said in the beginning, what matters is management and strategy. Managing housing is hard. It's not an easy business. So yes, you buy a property at today's price and you're really good at managing and you can keep it occupied at 94%. You can keep your delinquency down and you can keep your operating expenses down. Yeah, it can do really well, but those aren't easy things to do. And because values just keep going up, 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 there's many people out there who are jumping into this industry who don't actually know how to execute and manage. And that's usually when problems arise, less that they paid too much or bought a bad deal or the market changed, that they struggled to manage it. They struggled to execute. So that would be my caution in investing in space, is that management is really, really important. When you're dealing with toilets and people, and it's hard. In terms of other asset classes, I'm far from an expert, but I would always encourage, and I know some people doing really great in office. Well, they're doing great in office because they're buying at major, major discounts. They're buying the best office building in a market at a crazy discount because everybody thinks office is terrible. Right? It's kind of like having the best manager. Well, if you own the best office building in a market, even if there's more supply than there is demand, if you have the best product and you can be competitive on rent because you paid a great price, you're going to still do fine. There's people doing really great in retail strategies. So as a general rule, yeah, retail is going to struggle. Office is going to struggle. Hospitality is going to be volatile. All these other asset classes don't have the consistency of housing does, especially in a recessionary environment. But with a great manager and a great strategy and purchased at excellent prices, they can be great places to be. And so I would just say, and we're not in any of those asset classes, but I just say they can be really phenomenal because everybody thinks housing is great today. There's hardly anybody today. 10 years ago, people thought housing was riskier and office was the place to be. Right. All the big institutions wanted you to be in office, and that was the safe bet. Now office is thought negatively upon, and everybody has realized the stability that comes from housing. So I would just, say that be careful, right? I mean, is the Amazon effect real? For sure it is. Does that mean that no retail businesses are going to do well? Of course not. Does that mean that destination malls are going to struggle? Probably, right? But everything's location dependent and management dependent.
Right. Okay. So let's talk about something that occurred in 2007 and 2008, and it has to do with the real estate market getting extremely over-levered. Which means people had way too much debt. I can remember the ads on the radio and the newspapers. Hey, if you got a home, we'll loan you up to 120% of the value of your home. And it was a scenario that was just an accident waiting to happen. And when that thing imploded, it killed the real estate market for several years. Now, you came out of that shining like a star because you saw the opportunities and started making acquisitions during that period of time. My question to you is, since you're on the lending side of things as well, Don, what are you seeing happening on the leverage side of things in the industry as a whole? And then what are you guys doing at DLP Capital, and how much leverage are you putting on properties?
Yeah, great question. So I'll answer that first from the lending side. So I think what you're referencing is mainly what most people think about in 2007, 2008 is homeowners taking out, mortgages on their home at crazy leverage points and doing the negative amortizing loans where they only pay the interest, or not even all the interest, or the principal goes up every month. And, the mirror test was the mortgage lending test, right? If you could fog the mirror, you were approved for a loan. And, all of that subprime type of lending that happened in 7, 8, I can say with confidence that's not happening. That has not come back. Certainly, don't get me wrong, guidelines are looser today than they were in 2015. But in general, banks and lenders have held to much more, I'll just say normal credit guidelines than what we experienced in 7, 8. So that hasn't happened. That's a big reason to why we were able to weather what happened last March in this country, and we have had really, really low default rates in mortgages for a long time now. And so those guidelines have stayed reasonably tight. My world of lending, I don't lend to homeowners. I actually only lend to full-time professional real estate investors. And that industry has definitely, people have gotten looser in guidelines and are doing higher leverage, to your point. We've stayed on average for the last 8 years. We've averaged 27% down payment by our borrowers, 27% of the purchase price plus 27% of all the costs of renovating the property. And that significant skin in the game, I believe the number one criteria. So I used to tell this a lot to my investors, back when people used to worry about that, when it was closer. People have short memories, but when people used to remember a lot about 7 and 8, I used to tell people, all right, so there were 10 million homes that went into foreclosure in 2007, 8, 9, right? Take a guess at what percentage of those 10 million, let's call it, the people put down 20% down payment.
Zero.
Right? Almost zero, right? Exactly. Yeah. So almost zero, right? So, but any seasoned credit officer or lender knows that the number one criteria of loan repayment is skin in the game, right? So what we've stayed really disciplined on in all our years of lending is skin in the game. We've always required a lot of skin in the game, and that's what's going to ensure repayment even in recessionary environments. It's why over our 1,000 loans we have in our portfolio, we've had one borrower go 30 days delinquent since COVID started. One. So we really focus on our average loan to value in our portfolio is 54%.
Crazy. That's incredible. That's good. That's conservative.
Yeah. Exactly. So we've stayed that course through the craziness of the last number of years, and that's why we've had such great performance consistently. So I believe very much in the foundational kind of rules of credit, and skin in the game is always number one. So in general, I don't think we're going to have that kind of problem that we had in 7-8 again. Number one, because in 7-8, what people forget is we had the greatest oversupply of housing we ever had. Today, we have the greatest undersupply. In addition, we're not having these loose credit guidelines that we had back then. And then lastly, which is an interesting point, I think, is, back in 7-8, there was one way to sell a single family home, essentially. Back then, you sold to another homeowner, right? Today, a huge percentage of the market, depending on the part of the country, anywhere from 10 to 40% of the market is now owned by investors who then rent those homes out. So the fact that there's this underlying investor market that would love for property values to go down to buy up more houses, I think that's going to help buoy property values even in a recessionary environment, because there's so much capital that has realized single family is a real investable asset class.
Yeah, that's fascinating. Okay, you're making really good points there, and it kind of gets back to I did a show here recently on debt, and we looked at since 2000. Household debt has increased by 240%, yet debt service as a percentage of household income has declined by 19%. And so the natural thing that we see there and what we understand is that while there is more debt out there, the actual cost of that debt is much lower. So the debt service as a percentage of household income has declined. And so it almost makes that additional debt that everybody's trying to make a big deal of kind of irrelevant. Not totally irrelevant, but it's not as big of a deal as the headlines would make you to believe. Look at how much debt American households are in today. Gosh, they're in worse shape than they've ever been before. But reality is, when you look at the debt service as a percentage of household income, they're in better shape than they've been in a long, long time.
And that's the crazy thing is you think about the home prices. Everybody talks about home prices are going up so much, and they are. I mean, it's unbelievable. But the average cost of a mortgage today, to your point, is less than it was in 2006. It's less than it's been at almost any point in the last 20 years. What the average payment is, which is how most people unfortunately live, right, is based on payments, is actually down. I think the interesting thing, and I know you kind of started your triple threat kind of comment about, stock values plummeting or going down a lot, where the debt has grown tremendously. And I'm not the expert in this space, but I've read some great literature from Howard Marks, Oaktree, and he's put together some of his, I forget what he calls them, but his thoughts on this. And corporate debt has skyrocketed, right? So obviously government debt has grown probably the greatest percentage, and then right behind that is corporate debt. Household debt has been significantly more modest in terms of real growth, but corporate debt has skyrocketed. And not only are valuations at all-time high, but corporate debt's at all-time high. And
now the corporate debt deal is another whole phenomenon, and it's a balance sheet deal, right? So what the corporate debt, a lot of the corporate debt that's been taken on has been for stock buyback programs. So they're issuing bonds and buying back shares. And the little secret is out there that you can boost your earnings per share if you have fewer outstanding shares. So let's go out and buy some of our shares back and make our earnings look better on a per share basis. But then we just took on the debt to do that. Financially, that's been great for corporate America, over the last decade for sure. There's zero question that, but that's one of the things that's helped buoy the market, and the low interest rates have helped buoy the market too.
Of course, that's the opposite. I would say that's the opposite of what we want, though, in terms of we'd rather have these companies investing in growth and infrastructure and hiring people instead of buying back their own stock.
Right. There's a lot of them that are doing that, but it is a shell game kind of. If you really don't understand what's going on behind the scenes, you think that, wow, this company just keeps earning more and more and more, and the reality is they just have fewer shares outstanding, so their earnings per share increase. Part of their forecasting, right? All right, so let's talk about that book you have out. I know that it doesn't necessarily pertain to what we're talking about here today. You sent me a copy of that book. It's fascinating, and it's all about how to build an amazing company. So if there's anybody out there listening or watching that's got an entrepreneurial spirit and they can learn a lot from what you've done there, Don, which is just super impressive. We'll also put a link to your website in the show notes and a link to a spot where people can go and buy that book. So tell us a little bit more about the book. How's it selling, and are you getting any feedback from it?
Yeah, thank you. And I actually would say the book actually does tie a lot into what we're talking about in a way. And so the book is called Building an Elite Organization, and kind of the subtitle is The Blueprint to Scaling a High Growth, High Profit Business. And really what it is at the end of the day is it's a book on how to run a company, how to manage a company. And as I said, kind of on my onset, what's really important in investment is great management and a strategy that makes sense for where we're at in the investment cycle, et cetera, right? So great management is about disciplined execution. And the great Jim Collins wrote a phenomenal book called Great by Choice, and he studied all these big, huge, giant companies like Southwest Airlines and so forth, and what really made them so great. And what he came down to at the end of the day, what his conclusion was after 4 years of research was in essence what my book is about, which is running a disciplined operating system, what he called the 20-mile march, which is one of our core values. So it is really, really critical that any company you're investing in is running a disciplined organization, but certainly anybody listening looking to scale an organization as a CEO or as a leader, executive of an organization, you get some value out of it. It's been phenomenal. Launched the book in April, been number 4 on USA Today, number 5 in Wall Street Journal, number 1 in all of Amazon. So we've had some pretty great sales and phenomenal feedback from it, and it's been a humbling experience for sure, especially hearing feedback from people putting it into action. It's been pretty awesome.
Well, amazing. Congratulations again, Don Wenner. He's the owner, creator, founder of DLP Capital. It's such a pleasure to have you back on here to the Guided Retirement Show. Again, a link in the show notes to Don's website, as well as a way to buy his book. And I encourage people that are of the entrepreneurial spirit to read it. Check out all the things that Don has done. It's an inspiration for really the American way of life here, Don. So thanks for being here, and I hope you have a great day.
Thank you, Dean. Been a pleasure.
If you're watching this on YouTube, make sure and give us a thumbs up and share the podcast with your friends.
Starting your route to retirement.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.